When a 95-year-old man makes the largest financial decision of his lifetime, the motivation is no longer about maximizing returns. It is about eliminating catastrophic risk. That distinction matters, because the man in question is Warren Buffett, and the decision he just made carries implications far beyond his own legacy. On January 1st, 2026, after 6 decades at the helm, Buffett officially stepped down as CEO of Berkshire Hathaway. But the most important part of this story is not the transition of leadership. It is what Buffett did before he left, quietly, methodically, without headlines or dramatic announcements. Because before handing over control, Buffett positioned Berkshire in a way that reveals exactly how he views the current financial landscape, and what he believes may be coming next. If you are invested in American markets, if you have retirement savings, if you depend on stocks functioning normally to secure your future, this positioning should give you pause. This is not simply the end of an era, it is a signal. And historically, ignoring Buffett's signals has proven extremely expensive. Over the past 3 years, Buffett has done something unprecedented in his career. He has stopped buying stocks and started accumulating cash at levels never seen before in corporate history. As of September 30th, 2025, Berkshire Hathaway held $381.7 billion in cash and short-term investments. At the same time, Buffett has been a net seller of stocks for 12 consecutive quarters, unloading more than $184 billion worth of equities. This is happening while markets sit near all-time highs, while artificial intelligence dominates headlines, while valuations stretch further and confidence remains high. And that contrast is precisely why this matters. Buffett is not known for predicting market crashes. He does not issue warnings. He does not time tops. What he does instead is position for survival when assumptions fail. He builds balance sheets that can withstand extreme stress. And every time he does this, observers dismiss him as overly cautious until the cycle turns. Buffett has lived through every major financial shock of the modern era. The inflationary crisis of the 1970s, the 1987 market crash, the dot-com bubble, the 2008 global financial crisis, the COVID panic. In each case, he was criticized for being too conservative before the collapse. And in each case, he emerged stronger after it. The pattern is consistent. When markets become euphoric, Buffett becomes defensive. When risk is ignored, he prices it. And when assets are expensive, he waits. We saw this most clearly in 2007. As markets surged toward record highs and complex financial products flooded the system, Buffett reduced exposure and built cash. Investors complained. Analysts argued that he had lost his edge. Critics said the world had changed and that Buffett didn't understand modern finance. Then 2008 arrived. Lehman Brothers collapsed. Credit markets froze. Equity markets fell more than 50%. Retirement accounts were devastated. And Buffett, one of the few investors sitting on massive liquidity, became the lender of last resort. He struck deals with Goldman Sachs, General Electric, and Bank of America on terms no one else could offer. Those investments generated tens of billions in profits, not because Buffett predicted the crash, but because he prepared for it. The same behavior is unfolding again, only on a much larger scale. Today, Berkshire's cash position is larger than its entire publicly traded stock portfolio. The man who built his fortune buying businesses now holds more cash than equities. That is not a coincidence. It is not indecision. It is deliberate defense. This level of cash accumulation is not normal. It is not conservative diversification. It is preparation for systemic stress. Buffett understands something most investors forget. Markets are systems. And when systems become unstable, intelligent capital does not attack. It protects itself. What we are witnessing now is the early stage of that defensive posture. This transition does not happen suddenly. It unfolds in phases. And right now, we are well past the stage where confidence is justified by fundamentals. Buffett's actions suggest that the assumptions supporting current market prices, assumptions about growth, valuation, and risk, are no longer aligned with reality. And when the most disciplined investor in history quietly refuses to participate, it is rarely because opportunity is abundant. It is because risk is being mispriced. And that is where this story truly begins. To understand what is happening now, it helps to view Buffett's behavior through the lens he has always used. Systems, cycles, and probability, not headlines, predictions, or narratives. Great investors do not forecast exact outcomes. They recognize when systems become fragile. And when fragility increases, they shift from offense to defense. This process tends to unfold in identifiable phases. The first phase is confidence. This is the environment markets have lived in for years. Stock prices rise steadily. New technologies, most recently artificial intelligence, create compelling stories about limitless growth. Corporate earnings appear strong. Unemployment remains low. Indexes hit new highs again and again. Investors grow comfortable. Risk feels abstract. The assumption becomes simple. This time is different, and the market can sustain elevated valuations indefinitely. In this phase, caution is punished. Anyone holding excess cash appears foolish. Anyone questioning valuations is labeled outdated. Momentum replaces discipline. The second phase is blind risk. This is where subtle cracks begin to form, but they are dismissed. This is where Buffett's actions become especially revealing. From the fourth quarter of 2022 through the third quarter of 2025, Berkshire Hathaway sold more stock than it bought every single quarter. 12 consecutive quarters of net selling. In total, more than $184 billion in equities exited the portfolio. This was not because Buffett lost faith in American business. It was not because the companies failed. It was because prices reached levels where future returns no longer justified the risk. When valuation disconnects from underlying reality, cash becomes more attractive than ownership. Consider what he sold. Apple, Buffett's most important investment of the last decade, was reduced by approximately 74% from its peak position. At one point, Berkshire owned over 900 million shares. By late 2025, that figure had dropped to roughly 238 million. Bank of America was trimmed again. These are not businesses Buffett dislikes. These are businesses he knows intimately. What changed was not the quality of the companies, it was the price. At the same time, broader market valuation metrics reached extreme levels. The Shiller-Cape ratio for the S&P 500 touched 40 in late 2025, a level exceeded only during the dot-com bubble and briefly during the COVID-era liquidity surge. Historically, when valuations reach this range, future returns compress sharply. Over the following 3 years, markets often decline by 20 to 40%. This is not prediction. It is historical pattern recognition. The third phase is the quiet shift. This is where Buffett's actions diverge most sharply from market behavior. During the first 9 months of 2025, Berkshire executed 0 share buybacks. None. This detail matters enormously. Buffett has repeatedly stated that he will repurchase Berkshire shares when they trade below intrinsic value. In mid-2025, the stock declined approximately 14% from its peak. For most companies, that would trigger aggressive buybacks. Buffett did nothing. That single decision carries more information than any press release. If Buffett does not believe his own company's stock offers sufficient value at current prices, it raises a fundamental question. What does? Meanwhile, cash continued to accumulate at a historic pace. Berkshire entered 2022 with approximately $105 billion in cash. That figure rose during the COVID period, then accelerated sharply. By September 2025, it reached $381.7 billion, more than double the previous record. At this point, Berkshire's cash position exceeded the total value of its publicly traded stock portfolio. The investor most associated with equity ownership now holds more liquidity than equity exposure. This is not indecision. It is intentional. The fourth phase is the defensive bet. This is where meaning becomes unavoidable. Buffett has not abandoned stocks. He has not turned pessimistic. He has made a calculated judgment that at current prices, expected returns do not compensate for risk. Cash, yielding roughly 4 to 5% in short-term instruments, offers superior risk-adjusted returns compared to equities priced for perfection. Cash also provides optionality. It preserves capital during declines and creates opportunity when others are forced to sell. Buffett learned this lesson repeatedly, most dramatically in 2008. He's preparing to apply it again. Even so, Buffett has not completely stopped deploying capital. In the third quarter of 2025, Berkshire initiated a $4.3 billion position in Alphabet. That investment is instructive. Alphabet trades at a lower valuation than most mega-cap technology peers. It generates substantial free cash flow. It dominates its core markets. This is not speculative growth. It is quality at a reasonable price. But $4.3 billion out of $381 billion represents barely 1% of available cash. 99% remains on the sidelines. That ratio tells you everything. What this means for individual investors is not that markets will crash tomorrow. It does not mean panic selling is warranted. It means the assumptions underpinning current market behavior, assumptions about valuation irrelevance, perpetual growth, and frictionless returns, are being rejected by the most disciplined investor of the modern era. And historically, when Buffett and the market disagree at this magnitude, the resolution has not favored complacency. What Buffett's positioning ultimately forces investors to confront is not a forecast, but a probability problem. Markets today are priced as though everything must go right at the same time. Earnings growth must accelerate. Profit margins must remain at record highs. Interest rates must fall, or at least not rise further. Artificial intelligence must deliver trillions in real economic value, not just productivity promises. Credit conditions must remain benign, and geopolitical or systemic shocks must stay contained. All of those conditions must hold simultaneously for current valuations to make sense. That is the bet the market is making. By contrast, Warren Buffett is making a different bet. He is betting that one or more of those assumptions will fail. Not catastrophically, not overnight, but enough to force a repricing of risk. And when that repricing occurs, today's confidence will be revealed as fragility. This distinction matters most for people approaching retirement. If you are 25 or 30 years old, market volatility is largely theoretical. You have decades of earnings ahead of you. You can dollar cost average through downturns. You benefit from lower prices. Time is on your side. But if you're 55, 60, or 65, sequence of returns risk becomes decisive. A 30% drawdown early in retirement can permanently alter your financial trajectory. Even if markets recover eventually, the years lost cannot be reclaimed. Withdrawals during downturns compound damage. Recovery timelines stretch. Plans change. This is why Buffett's behavior is not merely academic. It reflects an understanding of time horizons that markets often ignore. Consider historical recoveries. After the dot-com crash, the Nasdaq took 13 years to regain its peak. 13 years is an eternity if you are already drawing income from your portfolio. After the 2008 crisis, markets required roughly 5 years to recover. Many investors sold near the bottom and never fully returned. Buffett avoids this not by predicting downturns, but by refusing to expose capital to unfavorable odds. And that brings us to the leadership transition. On January 1st, 2026, Buffett formally passed the CEO role of Berkshire Hathaway to Greg Abel. Buffett remains chairman, but day-to-day capital allocation now belongs to Abel. This timing is not accidental. Buffett would not step aside if he believed the next few years required aggressive expansion, heavy acquisition activity, or rapid deployment of capital. He stepped aside after completing the most defensive positioning in Berkshire's history. The fortress is already built. Abel inherits a balance sheet with $381.7 billion in cash, a diversified collection of operating businesses that generate tens of billions annually, and an investment portfolio structured to withstand prolonged market stress. Whatever comes next, whether it is a mild correction, a deeper recession, or something more disruptive, the groundwork has been laid. This is how Buffett prepares for uncertainty, before it arrives. The contrast between what the market believes and what Buffett is doing could not be sharper. Markets argue that artificial intelligence will redefine productivity and justify unprecedented valuations. Buffett acknowledges AI's potential, but refuses to pay unlimited prices for uncertain outcomes. Markets treat high valuations as irrelevant in a world of innovation. Buffett treats valuation as gravity, ignored temporarily but never permanently. One of these frameworks will prevail. History suggests that excess confidence resolves not through continued euphoria, but through repricing. When that happens, liquidity becomes power. Cash is no longer dead money. It becomes leverage, not financial leverage, but strategic leverage. Buffett understands this better than anyone alive. This does not mean the correct response is to abandon equities. It means aligning exposure with reality. It means recognizing that expected returns at current prices are lower while risks are higher. It means ensuring that portfolios reflect time horizon, not optimism. Cash, in this context, is not fear. It is optionality. Buffett is not betting against America. He is betting against overpaying. He is betting that patience will outperform urgency, that discipline will outperform enthusiasm, that waiting for the right pitch beats swinging at everything thrown. This has always been his edge. The greatest investors are not those who chase returns during booms. They are the ones who survive downturns with capital intact and deploy that capital when others cannot. That is what Buffett is preparing to do again. And the question this raises for every investor is simple, but uncomfortable. If the most successful investor in history believes risk is underpriced and patience is required, why does the market believe the opposite? To understand the scale of Buffett's preparation, it is essential to look beyond the cash headline and examine what is happening inside Berkshire.co.'s operating businesses. The fortress is not built on liquidity alone. It is built on cash flow, steady, recurring, and resilient through economic cycles. In the third quarter of 2025, Berkshire generated $13.5 billion in operating earnings, a 34% increase from the prior year. This growth did not come from speculative assets or financial engineering. It came from businesses designed to perform regardless of market sentiment. Insurance underwriting profits more than tripled year over year, reaching $2.4 billion for the quarter. The insurance float, the pool of premiums Berkshire holds before claims are paid, rose to $176 billion, up $5 billion from the end of 2024. This float is one of Buffett RS most powerful tools. It is effectively cost-free capital that can be invested while claims remain unpaid. Most insurers lose money underwriting policies and rely on investment returns to stay profitable. Berkshire does the opposite. It earns profits from underwriting and then earns additional returns by investing the float. This double-layered compounding is rare, and it is a core reason Berkshire can accumulate cash even while markets are expensive. If Berkshire earns a modest 5% annually on $176 billion of float, that alone generates nearly $9 billion per year in investment income before paying a single claim. This income stream does not disappear during recessions. It strengthens. BNSF Railroad contributed $1.4 billion in earnings during the quarter, up 5% from the prior year. Railroads are among the most durable businesses in the economy. They benefit from scale, limited competition, and irreplaceable infrastructure. Freight volumes fluctuate, but pricing power persists. When the economy expands, volumes rise. When it contracts, alternatives remain limited. That stability is exactly what Buffett values. BNSF does not need explosive growth to justify ownership. It needs consistency, and consistency is what it delivers. Berkshire Hathaway Energy produced $1.5 billion in quarterly earnings. Despite facing regulatory pressure and legal challenges related to wildfire liabilities, this segment illustrates an important nuance in Buffett's strategy. Not every business must be flawless. It must be durable. Utilities generate cash across economic environments. Demand for electricity does not vanish in downturns. Returns may fluctuate, but the business endures. Manufacturing, service, and retailing operations, often overlooked because they lack glamour, generated $3.6 billion in quarterly earnings, an 8% increase year over year. These businesses include industrial manufacturing, aviation services, and consumer retail operations. Individually, they may seem unremarkable. Collectively, they form a diversified cash engine. This is why Buffett's cash position is so significant. Berkshire is not hoarding cash because it lacks income. It is hoarding cash because it produces more cash than it can deploy responsibly at current prices. Berkshire generates roughly $50 billion in operating earnings annually. After taxes, reinvestment, and maintenance, tens of billions remain. Historically, that excess capital would be deployed into equities, acquisitions, or share repurchases. Today, it accumulates. That accumulation is not inertia, it is discipline. Book value per share reached approximately $485,000 per Class A share by September 2025, an 11% increase year over year. Over Buffett's tenure, book value compounded at over 18% annually. That rate of compounding, sustained for 6 decades, is not accidental. It is the result of refusing to overpay. When valuation discipline disappears, returns eventually follow. This brings us to the most misunderstood aspect of Buffett's current strategy. Holding cash is not a prediction that markets will collapse. It is an acknowledgement that expected returns from equities, given current valuations, are inferior to the returns available from low-risk instruments. When short-term government securities yield 4 to 5%, and equities priced at extreme multiples imply long-term returns closer to 3%, the rational choice becomes obvious. Risk-adjusted returns matter. Buffett has always prioritized them. This is not market timing. It is arithmetic. Buffett does not need a crash to be right. He only needs prices to revert closer to reality over time. Whether that adjustment happens slowly or abruptly is irrelevant to the logic of his positioning. The most important insight here is not what Buffett will do next. It is what he refuses to do now. He refuses to chase momentum. He refuses to justify any price with any story. He refuses to abandon valuation discipline when enthusiasm dominates. That refusal is his edge. What makes this moment exceptional is not simply the size of Berkshire's cash position. It is the context in which that cash exists. Rarely in modern financial history have markets been this confident, while one of the most disciplined capital allocators in history has been this restrained. This divergence is the signal. Buffett has spent 6 decades teaching the same lesson in different market environments. Price matters more than narrative. Over time, valuation determines returns far more reliably than innovation, excitement, or momentum. That principle does not change, simply because technology evolves or markets feel unstoppable. Right now, the dominant belief is that innovation, particularly artificial intelligence, changes the rules. That growth will accelerate so dramatically that today's prices will look cheap in hindsight, that margins will remain elevated, that economic slowdowns will be shallow, that liquidity will always be available when needed. Buffett is not rejecting innovation. He's rejecting the assumption that innovation eliminates risk. Markets often confuse possibility with probability. Artificial intelligence may transform productivity over the next decade. That does not mean every company exposed to it deserves any price today. Even transformative technologies go through cycles of overinvestment, disappointment, and repricing. History is full of examples. Railroads, automobiles, personal computers, the internet, each created enormous long-term value. Each also destroyed capital when investors paid too much too early. Buffett understands that distinction. That is why he does not rush. The most important advantage of holding cash is not protection. It is flexibility. When markets decline, prices fall not because businesses suddenly become bad, but because sellers become desperate. Liquidity evaporates. Financing tightens. Fear replaces confidence. In those moments, cash becomes scarce and therefore powerful. This is when Buffett acts. During the financial crisis of 2008, he was able to dictate terms because he was one of the few participants with both capital and patience. He did not chase bargains indiscriminately. He selected opportunities where fear had created mispricing and structured deals that protected downside while capturing upside. That playbook has not changed. The scale has. With $381.7 billion available, Berkshire can act in ways no other corporation can. It can stabilize companies. It can acquire entire businesses outright. It can negotiate preferred terms. It can move without leverage, without urgency, and without dependence on capital markets. There is a tendency in markets to believe that discipline becomes obsolete during periods of sustained success. When prices rise for years without interruption, restraint looks outdated, valuation looks irrelevant, risk feels theoretical. This is precisely when discipline matters most. Buffett's current positioning challenges the most deeply held belief in modern investing, that markets always recover quickly enough to justify any entry price. History does not support that belief. It tolerates it for a time, sometimes longer than expected, but it never validates it permanently. Markets are cyclical because human behavior is cyclical. Confidence expands, risk is ignored, leverage increases, expectations drift higher. Then reality intervenes, not necessarily through collapse, but through disappointment. Growth slows, margins compress, rates remain higher than anticipated, returns fall short of assumptions, prices adjust. The adjustment does not require a crisis to be painful. A decade of flat or low returns can be just as damaging to long-term plans as a sudden crash. Lost time compounds quietly. This is what Buffett is guarding against. The most overlooked risk in investing is not volatility, it is irreversibility. Losses early in retirement, capital deployed at inflated prices, forced selling during downturns. These are not temporary inconveniences. They permanently alter outcomes. Buffett has structured Berkshire to eliminate those risks at the institutional level. Cash reduces fragility. Diversified operating businesses reduce dependency on markets. Conservative capital allocation reduces exposure to error. This is not fear-driven behavior. It is probability-driven behavior. Consider what Buffett is implicitly saying about future returns. If equities were likely to deliver strong, risk-adjusted returns from current levels, he would be buying. He has never hesitated to act when odds favor him. The absence of action is itself information. What the market interprets as patience, Buffett treats as discipline. That distinction separates investors who survive cycles from those who merely participate in them. Another critical point is often missed. Buffett is not preparing for a single event. He is preparing for a range of outcomes. Slower growth, higher rates, credit tightening, policy uncertainty. None of these need to become extreme to justify caution. They only need to persist. Markets struggle with persistence. They price change quickly but adapt slowly. Buffett understands that time is the ultimate arbitrage. He is willing to wait years for favorable conditions because he has eliminated the need to act prematurely. Berkshire's operating businesses fund the wait. The balance sheet supports it. The culture reinforces it. This is what optionality looks like at scale. For individual investors, optionality is harder but not impossible. It does not require hundreds of billions. It requires flexibility, liquidity, and alignment between risk exposure and life stage. Being fully invested at all times is not a strategy. It is an assumption. Buffett rejects assumptions that cannot be defended with data. He also rejects the idea that inactivity equals ignorance. Often, inactivity is evidence of clarity. This is why the narrative around Buffett being out of touch resurfaces near market peaks. It happened in 1999. It happened in 2007. It is happening again now, each time the market rewarded enthusiasm briefly, then punished it severely. Buffett's advantage has never been speed. It has been endurance. The next phase of this cycle, whatever form it takes, will not reward those who chase the highest returns at the highest prices. It will reward those who preserved capital, maintained liquidity, and waited for mispricing. That is the environment Berkshire is built for. When the opportunity set improves, Buffett's successor will not need to scramble. The capital is already there. The authority is already delegated. The philosophy is already embedded. This is not the end of Buffett's influence. It is its institutionalization. The company he leaves behind does not depend on his presence to function. It depends on the principles he enforced for 6 decades: margin of safety, patience, discipline, and respect for risk. Those principles are now more visible than ever, not because Buffett is buying aggressively, but because he is refusing to. And that refusal is the message. When history looks back on this period, the most important detail will not be the exact timing of market movements. It will be the divergence in behavior between confidence and caution, between enthusiasm and discipline, between those who assumed the cycle would never end and those who prepared for the moment it inevitably changed. At 95 years old, Warren Buffett made the largest and most consequential bet of his life. Not a bet on a company, not a bet on a technology, not a bet on growth, a bet on patience. That bet is visible in numbers that are impossible to ignore. $381.7 billion in cash and short-term investments, 0 share buybacks despite price weakness. 12 consecutive quarters of net stock selling. A portfolio tilted toward resilience rather than expansion. A leadership transition executed only after the defensive work was complete. This is not pessimism, it is preparation. Buffett is not warning of imminent collapse. He is signaling that risk is mispriced and that returns no longer justify exposure at current valuations. He is reminding investors of a truth markets periodically forget. Price determines outcome far more reliably than optimism. Every major cycle ends the same way, not with universal recognition, but with disbelief. Markets rarely collapse when everyone is fearful. They correct when confidence is highest and protection feels unnecessary. That is why preparation always looks premature until it suddenly looks obvious. Buffett has always operated ahead of that realization. The most dangerous assumption in investing is that time will always repair mistakes. Sometimes it does, sometimes it doesn't. Lost decades do not announce themselves in advance. They reveal themselves only after opportunity is gone. This is why Buffett's behavior matters more than commentary. He has no incentive to posture, no audience to impress, no performance benchmark to chase. His only responsibility is stewardship, protecting a system designed to endure beyond him, and that system is now complete. Berkshire Hathaway enters its next chapter with the strongest balance sheet in corporate history. Businesses that generate cash, regardless of economic conditions, and the flexibility to act when others cannot. Whether the next cycle brings correction, stagnation, or something more severe is almost beside the point. The company is positioned to survive first and capitalize second. That sequencing is everything. For investors watching from the outside, the lesson is not to mimic Buffett's allocations. It is to internalize his priorities. To understand that risk is not volatility, but fragility. That liquidity is not laziness, but leverage. That patience is not passivity, but strategy. Markets reward participation during booms. They reward preparation during downturns. The difference between those rewards is measured in decades. Buffett has chosen the second. When the market eventually resolves the tension between price and reality, capital will move quickly. Fear will replace certainty. Liquidity will vanish. And the ability to act will belong to those who preserved it. That is the moment Berkshire is built for. The biggest mistake investors make late in cycles is believing that preparation can wait, that there will be time later, that signals will be obvious. They never are. By the time consensus shifts, opportunity has already passed. Buffett understands this. That is why he prepares, while confidence is high and caution is unpopular. That is why his actions matter more than any forecast. The market is currently betting that momentum continues, that valuations remain elevated, and that growth justifies everything. Buffett is betting that discipline will eventually be rewarded. One of these bets will define the next decade. The difference is that Buffett does not need to be right tomorrow. He only needs to be prepared when it matters. And history suggests that when patience and enthusiasm collide, patience wins. At 95, Warren Buffett has nothing left to prove. His final lesson is not about how to get rich. It is about how to avoid losing what you have built. The fortress stands. The cash is ready. The discipline remains. And when the cycle turns, as it always does, the difference between those who waited and those who chased will become impossible to ignore. That is the bet. And history suggests it is a very good one.